next 4 chapters are done. Buyback will have implications on both Companies Act as well as this paper. So this book that I'm displaying will be available to you on a website, which I will write down right now. You can go to uniqueacademy.com, and then you can download the same set of notes. They have a very good set of notes that they have updated here. So please use them. Now, for buyback, there are a few objectives that we need to remember. First is to ensure that the earnings per share is improved for the company, because the lesser the number of shares, just like in takeover code, in buyback, we reduce the share capital typically. One second, guys. What is it? So in takeover code, the acquirer will take the shares from the target company's shareholders. That's what we learned before lunch. But in this case, target company itself will take the shares from the shareholders of this target company. And that is mainly done to, number one, reduce your overall outstanding liability towards the repayment of these shares, and also the overall earnings that you have. EPS as a formula can be represented by total earnings divided by number of shares. And in this case, it is equity shares. So if your company makes 10 crore profit and you have 1 crore shares, the earning per share becomes 10. But let's say you bought back half of your shares, the denominator goes down. So 10 crore next year, if you make, the number of shares is only 0.5 crores. So your earning per share becomes 20. So your EPS is actually increasing. And this helps the company also to improve its overall net worth in the long run. It also is a very good way of avoiding a takeover, because if the number of shares that are with public is less, out of 100 shares, 20 is already with promoter, which they generally will not sell it to the acquirer. Out of the 80, the lesser the number of shares that the public has. If you do buyback of 20, your new share capital will be 80, promoter will still be 20, but the public will have 60. If you do one more buyback, your share capital becomes 60, 20 is with the promoter, and only 40 is there with the public. So this way you are reducing the share capital that is available with the public, which will eventually not allow the acquirer to buy the shares from the public. It also helps you to service the equity more efficiently and to achieve a better capital structure. A very simple chapter. You have to remember two percentages, 10% and 25%. If it is 10% of your net worth or less, you only require a board resolution. If it is less than 25% of your net worth, you require a special resolution to complete the buyback under Companies Act. But from capital markets perspective, we also need to learn a few extra things. Number one, you can only use your free reserves and securities premium account to source this buyback, or you can issue new securities. For example, you're buying back 20 lakh shares and you're paying 100 rupees per share for the buyback. So 20 lakh into 100 will be how much? 20 crore rupees. How will you arrange 20 crore rupees? You can use your free reserves. Let's say your free reserves are 5 crores. You still need to arrange 15 crores and pay the people. You can use your securities premium account balance. Let's say securities premium is 3 crores. Now you're left with 12 crores. Out of 12 crores, you have no other source. So now you can issue a debenture. You can raise 12 crores. And using this 12 crores, you can pay the equity shareholders because in a buyback, you have to pay which shareholder. Payment should be given to the existing shareholders. That payment can only be given if you source your buyback like this. So that is how typically buyback functions. In addition to this, all the conditions that I've told you before, the 16 defaults, if you have committed, you cannot do buyback. If your AOA doesn't authorize, you cannot do buyback. With board resolution or special resolution only, you can do the buyback depending on the percentage. And if you are paid up capital, which capital paid up? Equity capital and free reserves is sufficient. And if it is less than that, then only you can require a board resolution to approve this particular buyback. Otherwise, it is special resolution. Your debt equity ratio should also be 2 is to 1. If we summarize all of these things, buyback, first is sources. What are the three sources of buyback? Free reserves, securities premium account, and fresh issue of securities. How much you can do buyback? Lekha, what do you think? How much buyback can we do?
25%.
If it is less than 10% of paid up equity capital and free reserves, it is going to require a board resolution. If it is 10 to 25% of paid up equity capital and free reserves, then you require special resolution. What are the conditions AOA should authorize? No default the company should have committed all the 16 defaults the company should not have committed, which we saw in the morning. And you should pass resolutions. We know the resolution passing process is another 7 steps. So if we follow this, buyback is done. Debt equity ratio should be ideally 2 is to 1. And make sure that you complete the buyback in 1 year. And all the payment and other procedural requirements should be completed by particular time by the listed company. Now, there are some methods in which you can buy back the securities. Either you can go to the open market and you can say free for all. Whoever wants to sell their shares, they can sell. Or you can only buy back from odd lot holders. One lot is usually 100 shares. Anybody who has 97, 96, 95, and such shares, till one share, all such people shares you can buy back. That is called as a odd lot. Let's say somebody has 103 shares. How many will you buy back? You will buy back 3 shares from him so that the lot is complete. Somebody who has 197 shares, you buy back 97 shares from them. This technique is called as odd lot shares. And these people who hold these shares are called as odd lot holders. The third method is to get it from the existing shareholder in a pro rata basis or a proportionate basis. So any person who has 3 shares, we will buy back 1. So 3 is to 1 ratio fixing is called as pro rata basis. From open market means free for all. Odd lot meanings any odd number of shares, if anybody has, they will be only used for this particular buyback. This open market route has two ways in which you could do it. You can do book building and you can do stock exchange. Do we remember what we do in book building process? Who fixes the price, company or public?
Public.
Public will fix the price for buyback also here. And here the company will typically fix the price if it is through a stock exchange method. So what are the methods of buyback? Odd lot, open market, and pro rata. If it is open market, you can do book building or you can do stock exchange. Now, prohibitions I've already seen. All the defaults come under the prohibitions themselves. And you need to have a SR or a board resolution, and your AOA should authorize accordingly. Now, let's look into the process as such. Once the buyback is done, make sure that you file a return on buyback within 30 days. So that's another additional condition that you have to satisfy, which we will call as compliances. Under compliances, you have return of buyback, plus you have to make changes in register of members because many of their names should be deleted. Plus, you have to also make payment of consideration within 30 days of the tendering period. If you remember tendering period, we have learned the definition in the takeover code itself. That is why we did takeover code first. So this is how buyback chapter typically works. Okay. So this is our fifth chapter. What are the sources of buyback? Free reserves or securities premium account, or you can issue not shares, some other type of shares like preference shares or some other debentures. How much buyback can we do? Up to 25 maximum. If it is less than 10, take board's approval. If it is up to 25, take general meeting approval. AOA should authorize no default you should have committed, 16 defaults. Pass resolution process, which resolution, board or special. If it is special, you need the 7-step process. Debt equity ratio should be 2:1. Buyback should be complete within 1 year. What are the three methods? Odd lot, open market, or pro rata. Under open market, you can either let the public decide the price or let the company decide the price. And under compliances, you file return of buyback, changes in register of members, you make the payment within 30 days of the closure of the tendering period. Once you have satisfied all of this, buyback is deemed to be complete. In between all of this, do we need an explanatory statement? Are we doing ordinary business or special business? What do you guys think?
Special business.
We are doing special business. Always remember, okay, you can write this now. Common point number, how much is this? How many common points we have? Everybody forgot the common points. Common point 1 was 3 and 9. What is 3?
Objectives.
What is 9?
Powers.
What is second common point?
Uh, Types of financial markets.
Types of markets and securities. We have 5 plus 3 plus 2, which is 10. And common point number 3 is what?
Procedure to pass special resolution or vote.
Procedure to pass resolutions under Companies Act, which is a 7-step process. This is 12. What is 4? Defaults.
Defaults.
You have 11 plus 5, which is 16. Or was it 11 plus 4? It was 11 plus 4, I think. And whatever it is, let's call that as your fourth. Now we are talking about the fifth. Do we have any fifth before this? We don't.
No, sir.
Now we talk about contents of explanatory statement. What do you write in an explanatory statement? Very simple. Okay, let's list it out. When, how, how much, where, why, who, and for what. Which is the basic questions of life. When are you doing the buyback? So in this scenario, what will be the explanatory statement? When are we planning to do the buyback? When is the tendering period? How are we planning? Are we doing open market? Are we doing odd lot? Or are we doing, what is the third method?
Pro rata.
Pro rata. How much are we proposing to buy back? Are we proposing to buy back 12%, 15%, 18%? You have to define that. Where is this buyback going to happen? Probably register office of your company, that location. Or if you're a listed company, those locations you have to send a notice or advertisement, which is called as public announcement. So in which language? In English, in Hindi, and one vernacular language. Why are you doing buyback? You have to talk about the objectives. Do you want to improve EPS? Do you want to avoid a takeover code? Are you planning to reduce your liability, or do you have too much profit, or do you have too much cash outstanding you want to pay? You know, make sure that you buy back and reduce your liability, whatever is the reason. And who are you buying back from? Which set of existing shareholders? That will be related to this answer. And after buyback, what are your plans? So you've done buyback. So for whatever you have done buyback, after that, what are you planning to do? Now imagine what will be the explanatory statement for appointing a director. When are you appointing him? How many directors are you appointing? What is their remuneration? Where does he come from? Why are you appointing an extra director? Who is he? What is his qualifications? And what purpose or role is he going to serve in the organization? Let's take another chapter, takeover code. Acquirer also has to obtain resolutions from his own company, right? So he has to say why he's so interested in this company, when is he planning to do the takeover, how is he planning, who are the PACs, how much money does he have, where is the target company located, and what are his plans for purchasing these shares, why is he buying these shares, who are going to be involved in this process, and what is the ultimate goal. So these answers will always be there as part of your explanatory statement. Sorry. So contents of explanatory statement also has how many points? 7 common points. So see how many we have. 12 plus 10, 22 plus 7, 29 plus 15, 44 plus 7, 51. Just enough to hit the majority. 51 points you can use to score, let's say, even half of these marks if they give you. Use according to the scenario, whichever question deserves which of these 51 points, use it there. This is the most useful, these 15. You can pretty much write it for every damn question. So these 51 points will really help you, and that is your buyback chapter also. Let's move on. Let's take another one. Let's do collective investment schemes. Chapter 6. CIS typically is a trust, but can also be a company, can be a LLP or a body corporate. What do these entities typically do? They will collect money from investors, and they will invest the money where, as per objectives, they will invest. If it is a trust, you will have a trustee. If it is a company, you will have a director. If it's a LLP, you will have some designated partner. Or if it's a body corporate, you will have some manager or person in charge. All these schemes, whether they are registered or unregistered, both of them come under the purview of these regulations. So let's talk about CIS. CIS means CIA comes. Now, this collective investment scheme, if it is registered, who will you register it with? SEBI. But if it is unregistered, the corpus should be 100 crores or more. Even if you're an unregistered entity, like a unlimited liability partnership firm or some cooperative society, and you're collecting money from people and investing, even though you're a cooperative society, you are deemed to be a CIS from the eyes of SEBI because of Sahara versus Income Tax Appellate Tribunal case, where Sahara India used to float a lot of schemes. These schemes were given individual managers, and those managers used to go area to area to collect 100 rupees, 200 rupees per month from all these poor people. And they were given a promise that after 1 year or 2 years, their investment will double. But neither did it double. Most of the money was stolen by the owners of Sahara itself. So, if you invest in any scheme, entity name is CIS, but each scheme might have a different objective. A scheme is typically going to be income oriented, growth oriented, or capital appreciation could be one of the goals, or tax saving could be one of the goals. Depending on the objective, each scheme might be different. So one CIS might have multiple schemes. So let's talk about CIS. What is a CIS? CIS is a it's a collective investment scheme. What is the form it usually takes? It's a trust, company, LLP, or a body corporate. Should it be registered? Yes, with SEBI. But even if it is unregistered, the corpus should be more than how much?
100 crore.
100 crores is the corpus. Next, they can float multiple schemes based on objective. The objective could be income, growth, tax saving, etc. The people involved are called as sponsor, trustee if it is a trust, unit holder, who's also called as beneficiary, and the collective investment management committee company, which is the fund manager. Fund manager is nothing but a portfolio manager. They will decide where to invest the money. All the money that is collected, that decision is CIMC. Who appoints the CIMC? Trust. Who appoints the trustee? Sponsor. Sponsor should also invest a percentage in the net worth of the CIMC. Then only there is some interconnectivity here. So any contribution that is made to any of these schemes should only be used for the scheme objective. Plus, what is not a CIS? Any other normal cooperative society, any NBFC, so we can just write it down, cooperative society, NBFC, insurance company, pension scheme or pension fund, provident fund. Why pension fund and provident fund are not a CIS? Because they are a QIB, qualified institutional buyer, plus any other company which is accepting deposits under Companies Act, any Nidhi company, any other mutual fund. These entities are not a CIS. So a CIS is a very unique type of entity. Can we say all these other entities also take money? They also invest money, but they are not called as a CIS because they are having their own rules to follow. CIS is governed by SEBI, so it has its own set of regulations to follow. So it could be an entity which is managed by a CIMC. What is a CIMC? Collective Investment Management Company. Lot of short forms in this subject. That's the trend here. So always keep these things in mind. It's a company incorporated under Companies Act and registered with SEBI. Their main job is to manage the investment of a CIS. So we can say they are the portfolio manager of a CIS. And a CIS can have multiple schemes and it can also have multiple CIMCs if it needs, or it can allow the CIMC to manage all the schemes of the CIS. The property that is owned by the CIMC, that will be called as the CISP, Collective Investment Scheme Property. So wherever I take your money and invest, that is my investment. For a company, its investment is its asset. Therefore, it is considered CIS property. A CIMC cannot do anything other than managing the scheme. It cannot act as a trustee, obviously. It cannot launch its own scheme. Company will launch the scheme, CIS will launch the scheme. And it cannot invest in its own schemes. So your only job is scheme portfolio manager. What can you not be? You can't be trustee, you can't be investor, you can't be CIS also, who are obviously the three parties. Every CIMC should ensure, just like any company, they do due diligence, they manage the funds, they take reasonable commissions, and if they omit any information, they make sure that they are responsible for the same. They appoint intermediaries. Which intermediary will be appointed? Primary or secondary? Mostly secondary, because I am going to invest this money where? Mostly not in IPO, typically in a FPO. And even if I invest in an IPO, I don't need the help of a primary market intermediary. I am investing there. The company which is doing the IPO will need the help of the primary market intermediary. I am only an investor, so I will only need the help of secondary market intermediaries who are mainly brokers, investment advisor, portfolio manager, research analyst, and the other market intermediaries like credit rating agency, custodian, depository participant, etc. Monthly, you should send a statement and report. Have 4 board meetings. CIMC is a collective investment management company. Companies always have 4 board meetings once every quarter. So do that and keep sending the regular reports to it. Remember, typically our penalties are going to be 1 lakh to 1 crore rupees. If it is a serious offense, 3 times the profit made or 25 crores, whichever is higher. And that is your sixth chapter. Your main job is to assist in scheme documentation and money mobilization. So you will be making multiple reports regarding this as a CS for a collective investment scheme. So that is CIS chapter. CIMC obligations is the additional part. If you need a screenshot, you can take it. Otherwise, I will anyways be sending all these pages separately. Next. Hmm. Prohibition of FTP and UTP regulations. This is also a separate chapter. Any person who deals in security. What do you mean by dealing? What and all can you do with a phone? You can buy it, you can sell it, you can rent it, you can subscribe for things on it, or you can agree to do all of these things, or you can give it on lease or any other hire purchase sort of a situation, or you could make sure that you convince others to buy that particular phone. Same thing you can do with anything in this securities market. So, security, we already know three types: pure, derivatives, and hybrid. Pures is equity, preference, and debt. Derivatives is futures, forwards, options, and swaps. Hybrids is not in syllabus. If you do anything with these securities, or if you provide knowledge regarding these securities, if you provide information regarding these securities, if you assist in any of these functions, then you are a dealer in securities. When you are dealing, should you do fraud? So, what is this chapter all about? FTP, UTP should be encouraged or discouraged? Discouraged. How do you discourage? Only if you talk to dealers. Dealers will deal in securities. They should not commit any fraud. What is a fraud? Contract Act tells us intentional misrepresentation of facts. That is called as a fraud. Unintentional misrepresentation of facts is misrepresentation. And mistake is you did not even know what the fact is. That is a mistake. If there is any intentional omission, expression, or concealment, it leads to fraudulent trade practice. So, what are the different varieties of FTP? These are the ones. Misrepresentation, you don't give them data or you conceal the data. You suggest them something, buy Adani, it's a very good investment. And then Adani immediately thanks. Or you actively conceal from a person who already knows certain facts. You do many other things to make it look as if what you're saying is the truth. You promise to do something, you represent that you will be doing something, but that representation is very reckless or careless. You omit some data, you have a deceptive behavior towards them without involving them in decision making. You make a false statement or you give them misinformation. All of this is called as a FTP. If it is related to dealing in securities, remember, securities is the critical part of this definition. Some exceptions are there. If the government itself asks you to do it, you are exempted. If the economic situation of the country demands it, you are exempted. If there is a trend in security market and you made any statement in good faith, for all of this, the key word is in good faith. If you did this, then it is not considered to be a fraud. If you do a fraud, what will SEBI do? SEBI has what powers? SEBI can inspect, investigate, and inquire. SEBI can search, seize, and confiscate, and they can also impose penalties for such an act. They've already made the rules. That rules only we are reading. So if you do any dealing, what is dealing? Buy, sell, use, employ, engage, or give advice regarding to any of these schemes, or if you are found to be knowingly indulging in any of these acts, dealing in these securities, or inducing any person to deal in these securities, then you will be required to pay this penalty, but only after investigation. First, there will be inquiry. If inquiry response is not good, then they will come for inspection. During inspection, if they find anything suspicious, or if they are not happy with the inspection, then they will go for investigation. Here, directly, if you are accused of FTP or UTP, directly they will do investigations. And remember, powers of SEBI with respect to objectives. What are the objectives of SEBI? If you are found not protecting your interest of investors, if you are found doing any FTP or UTP, or if you are found disturbing the functioning of the securities market, in these three cases, SEBI's main objectives are being affected. Hence, they will come down very strongly against you. They can also call for information and inspection. They can ask who can they search, seize, or confiscate. We've already discussed in the first chapter, right? Persons or documents or books. They have those powers, and it is your duty to cooperate with them. Based on the investigation, they will then submit the report. So, what is the sequencing here? FTP, UTP chapter. First, what is practice? What practice? Trade practice. Trade practice means dealing in securities. What type of trade practice we should not do? Fraudulent or unfair. To understand that, we should understand the definition of what is fraud and the different types of fraud, which is eight. If you do this, what powers does SEBI have? III and SSC. After III, they will submit report. Once the report is submitted, SEBI will. Who will submit the report? To whom? Report is submitted by the
Investigator.
ins- inspector or investigator. And who will they report to? They will report to SEBI. Then SEBI will pass a order. Once SEBI passes an order, if you want, you can go for appeals, which we have again already seen. What order will they pass? Final order. Either they'll suspend your registration or they'll impose some penalties. Penalties we already know. Three times the profit made or 25 crore, whichever is higher. Okay, so that is seventh chapter. How many have we done? Forgotten. Chapter 1 to 9, takeover code, buyback, UTP and FTP. Anything else? Collective investment schemes. Seven done. Do you guys need a break?
sir.
Okay. Let's do delisting. Again, please go to the website that I mentioned. This entire book is available there. In addition, whatever I've written down as flowcharts and diagrams, I will forward it to you guys in the group also. Delisting is also related to buyback somehow and takeover code somehow. Because if you do too much takeover, it will result in delisting. If you do too much buyback, also, it will result in delisting. Delisting is the end of the company from the perspective of this subject. You'll still be a company, but you'll no longer be a listed company. So, delisting can happen due to two reasons: voluntary or compulsory. For this, I am sure I made something. I have to find it. Nothing crops up. Or is the search only gone? Mhm. Okay. Delisting cannot result in insolvency. You have to ensure that. Delisting cannot be done for IGP companies, which are startups. And delisting cannot be a way for reconstituting or re-evaluating any company. Delisting is typically done in two ways: voluntary and compulsory. If you want, you can delist from all stock exchanges. There are only two in India, BSE and. If you want to get delisted from both, you have to provide what is called as exit opportunity. To whom? To your existing shareholders. But for that, you have to pass what resolution? Special resolution. If you only delist from BSE and you continue in NSE, is it really delisting? It is not. So you don't have to give any exit opportunity. In exit opportunity, what will happen is indirect buyback will happen. Because if you're delisting, the remaining shareholders already, if you remember, for delisting, you already would have reached 90% shareholding, or in some cases, 75% and above. If you're already above this limit, why would SEBI not delist you? SEBI itself will take actions, right? But before this itself, if you want to delist, that is what is called voluntary delisting. If you already reach these limits, then it obviously falls under compulsory delisting. Here, exit opportunity means existing shareholders, should they be given a chance to sell their shares? Who will they sell their shares to? To the company, but somebody inside the company should buy it. Who will typically that be? That will be the promoters. So it's an indirect way of increasing promoter shareholding and reducing public shareholding. So delisting results in reduces public shareholding, increases promoter shareholding. If you are a small company, SME company, not small, in the SME segment of BSE and NSE, small and medium enterprises who want to list their shares are allowed to sell their shares. If you are a SME company, you have to give exit opportunity, but there is no bidding. When does bidding happen? Remember book building process. Similar process will happen here, but there people were bidding to buy your shares. Here people are bidding to sell their shares. I want to sell so much. I want to sell everything at this particular price. So the intent is different. The functioning is the same. So can we say delisting chapter is a combination of buyback rules, which we have already learned. Remember 16 defaults? Those plus AOA authorization is also required for delisting. But here, buyback had two possibilities, board or special resolution. Here it is always special resolution. Plus, you have to do what? Exit opportunity. And the exit opportunity, if you are exiting from all stock exchanges, you have to also allow what process? Bidding process. If you are a SME company, do you need to give bidding? You don't need to give any bidding. Okay. And we already know the process, 7-step process for passing the special resolution. Make sure that once you have uh, done the delisting, you don't cancel the shares. In buyback, what do? You destroy the share certificates or you cancel the demat account accordingly. So it is not a buyback. Delisting is not a buyback. It is also not considered to be delisting if you don't have 3 years listing track record. If you are only not listed for 3 years, why did you even get listed in the first place, right? You are having a very short span of listing track record. So from the date of getting listed, you need to stay listed for at least 3 years. Only then you can apply for delisting. Delisting cannot be done through preferential issue. What is another way of increasing promoter shareholding? Delisting increases promoter shareholding, but you take shares from existing public and then you transfer it to yourself. You pay them some money. But if you do preferential issue, can you do preferential issue at a very low price? You can. That way also promoter shareholding can increase. That way you cannot do delisting. Indirect delisting is not allowed. Plus, for voluntary delisting, you have to pass special resolution and you have to give IPA. It is not any type of liquor. It is initial public announcement. Every chapter has some public announcement. This chapter has two public announcements, initial and final. And where will you give the public announcement? Typically, two newspapers, at least English and Hindi. Your annual report should disclose the fact that you have done delisting. And within 30 working days, you should dispose the request for delisting. Whom? Who are you applying for delisting? No, stock exchange. You are applying for delisting in a stock exchange. So BSE and NSE, if they have seen all the documentation, they can't delay the approval that is to be given for delisting. Now, escrow account, you have to still open every scenario where you do any public announcement. There will always be some amount of escrow account obligations. Escrow account is the account which is created typically for ensuring that you have sufficient money to do the process. When and all do we need money? When we issue securities, company needs money. When company does buyback of securities, company needs money. When they do delisting also, who needs money? Promoters need money, but somebody needs money. In this case, it is promoter. If you do takeover, you are buying another company's share. Then who needs money? Acquirer plus PAC need money. So who will open the escrow account? These people will open the escrow account. For up to the first amount will differ from chapter to chapter. For the first 100 crores or 500 crores, the money that you should deposit in the escrow account is 25%. 100 is for these, 500 is for this. Afterwards, any extra amount you need to deposit 10%. Suppose you are doing takeover. If we have to do Adani takeover, how much money we need? We need 2 lakh crores, let's say. 2 lakh crores. What is 25% of first 500 crores is how much? You deduct 500 crores from this. 1,99,500 crores. For 500 crores, 25% is how much? 125 crores. And 10% of this is how much? 19,950. How much will you totally deposit in escrow account? 20,075 crores you will deposit in the escrow account even before starting the takeover, because they need to know that do you have money? You need how much money? 2 lakh crores. At least you should have 20,000 crores, right? In order to start paying these people. You can't say, sorry, bank didn't give approval, it got delayed. This money will be put in escrow. If you don't fulfill your open offer obligations, this 20,075 crore will be forfeited. And who will get a share of all of this? The existing shareholders of the target company. So this is a compliance mechanism. Now, same thing applies for buyback and delisting at what level? 100 crores. For 100 crores, what is 25%? 25 crores. Let's say our buyback is 150 crores. 150 crores ka first 100 crores is 25. Extra is 50. 50 ka 10% is 5. So total how much you deposit in escrow? 30 crores. If you're doing 150 crore buyback, you deposit 30 crores in the escrow. Who deposits? Company. Delisting means promoter, and takeover means acquire and PAC. Then only you will give detailed public announcement. Before you do this, you cannot give the announcement. Where do you give the announcement? To newspapers and stock exchange. Also, you give one announcement. Then you give letter of offer. In this subject, we don't call it prospectus, we call it letter of offer. That's all. We are not issuing securities. That is also one more reason we don't call it prospectus, we call it letter of offer. Then bidding period will start. If you are giving voluntary delisting, bidding is compulsory. If you're a small company, bidding is not compulsory. If you're doing delisting from one stock exchange also, exit itself is not compulsory. So bidding will start for at least 5 days. After bidding, give one more public announcement. Say that bidding is over. We have got all the bids. We will now discover the price. Which price? Some people are ready to give it for 5 rupees. Some people are ready to give it at 10 rupees. Some people want more. So you take a weighted average of all of that. So typically, if you issue shares, you calculate weighted average price. But if you are doing delisting, you have to find out the discovered price. Once you discover it, pay it. Also decide how many minimum number of equity shares that are required for you to do delisting, because 90% you should hit, right? You might be at 77, 78, 79. How much are you buying from this public so that promoter shareholding is how much? At least 90% or more. And within 1 year, you can give the remaining shareholders also one more chance. If you want, sell your shares at the same discovered price. Look, you guys didn't agree. You guys were adamant. Even though we bought 90% of the company, you still stayed. Even though the company is unlisted, you still stayed. But I'm going to give you one last chance within 1 year. If anybody else wants to sell their shares, please come. I'll give you the same discovered price. After 1 year, if this company goes broke, not our fault. That is your delisting chapter. 8 chapters done. Any doubts here? Any queries?
No, sir.
Okay, take one more break. 5 to 10 minutes, process all of this. I know things are going quick.